Hi everyone, I'm Paul, and in today's video we're going to be going through the homework from ICT's 2022 Mentorship Program for Lesson 2. No one really likes homework, so let's jump in. So as always, we'll just run through a quick overview of what we'll cover in today's video. So this is the homework from Lesson 2. And so the primary part of the homework was to review the charts from the mentorship video, but as a little bit of a bonus, I've done a pretty much end-to-end walkthrough using a BTC example. And so I'm going to try to do a review like fully end-to-end of the ICT fair value gap methodology on this particular example. So that's, looking for breaks in market structure and imbalance in price, trying to figure out where the liquidity resides, and then back test how much the total return could have been. So the trade that I've used for this particular example is on the 21st of February 2022, if you want to have a look at that yourself. And just as revision for what the trade setup looks like, we use the weekly chart to determine our bias. We then use the daily chart to locate liquidity and imbalances. We then zoom in to use the hourly chart to observe the price seeking liquidity and all those imbalances. We use the 15-minute chart to zoom in even closer and look for stop hunts. Then once we've done that, we use the 1 to 5 minute chart for trade entry, exit and management. So I'll run through a full example using BTC for that as an extra bonus. So the homework for lesson 2 centers around Nasdaq E-mini futures on the 21st of January 2022. So this is the daily chart. So we already have our weekly bias. We're bearish, we're expecting price to go lower. And then using the daily chart, we've used this 18th of October date as where we think price is going to draw to. So we've just marked that up there, and we're expecting price to move towards that over the course of this week. So if we then zoom into the hourly chart, we can see that the market sold off in the evening session leading up to the market open. We'll just play this forward a little bit and we can see what the market does. So using the end of our previous session, we can just mark out some key levels. So our level here would be the low from the previous session, and you can see we had highs here from the previous session residing around here. The other interesting thing from this session is we have these fair value gaps here and here. All right, so let's zoom closer into the 15-minute chart, and remember we're using the 15-minute chart to now look for price, going on the stop hunt. So keeping in mind we're looking for lower prices, so what we're expecting to see is the market move up, take out stops, and then move to the downside first. So we're expecting a move in the opposite direction to the overall move we're anticipating. And if we zoom right in, you can see that this is that markup that we did from the 18th of October. So this is where we think price is going to draw towards. So this is the beginning of the session and the end of the session. So let's just play this forward a little bit and just watch price start to attack these stops. So we can see the market is open and moves higher, consolidates higher. Now we have this level here and here, so we have stops starting to be formed here. Now remember, because traders would be looking to go short here, they will have sell stops sitting up here, so this is where we'll have liquidity starting to form up here. And we've already had the market move downwards, which is what we're expecting in anticipation of a move back upwards. So they've attacked these stops down here. So we have liquidity here, which we marked up from earlier. So this is the lows of the previous session. And so this is where we would expect stops to be residing. So we'd have traders going long here and have their sell stops residing below these lows here. So we can see the market's attacked those stops. We'll just play this forward and we can see that the market will race higher again. And again, we've come right back up to this level. So we now have 1, 2, 3, 4 touches at this level where we would have traders going short, continuously putting their stops here. So remember, they're going short at this level, seeing this as resistance, creating additional liquidity up to this point. And this is where we're expecting price to shoot into, to generate all of the, trigger all of those stops to generate that liquidity for institutional traders to be able to get set. So the area that we want to concentrate on is this area here, We'll just jump into the 2-minute chart to look at this whole sequence in more detail. So just as note, I'm using the NDX for this particular section of the video. The NQ1 doesn't go back far enough in terms of this granular data, so I'm just using the NDX, but it looks very similar. So if it looks slightly different, that's the reason why it's a little bit different. So we can see here, this is the beginning of the session, and this is that push down into liquidity. So this was the liquidity that we marked up down here on the 1 hour chart. That was down here, so we can see the market drives down into that before it comes back up, and we run into these equal highs. This is that then push through above these equal highs, which is where this liquidity is generated before the market then trends lower. So the things of note that stand out on the chart once we zoom into this 2-minute is we have the push down here into the liquidity, so where these sell stops were residing, and you can see this short-term high was created here, and it's this drive up which breaks market structure here. So this candle here is the candle that breaks the high of this candle. So we have a short-term high which is a lower high from here, and this now creates a higher high, which is obviously a break in market structure there. And you can see that we have these small fair value gaps that are actually being created as the market drives forward. The market then climbs up and we run into these equal highs. So again, we have these highs being formed, which retail traders would be looking at as resistance. They would be going short here and placing their stops above the highs here. The market then pushes through those, so it takes advantage of that liquidity, triggering off all of those stops, which allows the institutional traders to get set, which precipitates that move downwards. So the reverse of this is what happens up here. Once we push into this liquidity, we have this short-term low formed here, and this is where our fair value gap is also formed. So we have this initial push back up, and then we have this big candle down. So this is the more powerful candle down, which breaks market structure. So we get a new low created here. So this is a lower low. So we had a low, a higher low, and now a lower low. So this is the move that breaks market structure. You can see it breaks it here. And this is our fair value gap that's formed here. The market immediately trades back into it before it then runs away. And that's obviously where we would enter that trade. And the exit that ICT looks for in his video is down here, where there'd be obviously stops residing here and then targeting this fair value gap just there. So that's where he looked to exit the trade. But as we know, that there was actually more available on that trade if you were going to hold through. And so next is the BTC bonus example. So the trade date we're looking at is the 21st of February 2022. And you can see from the screen that I've got here, we're looking at the weekly time frame. So at the moment we've got up to the 14th of February, and the 21st of February is obviously the next weekly candle that we're expecting. And so based on the price action so far, you can see we've had a run up here. We've got this like shooting star type candle here, and then another pretty bearish candle here. So this has obviously got an extended range, a long wick. And so after two bearish candles like this, expectation is that we'd have more downside. Maybe not necessarily as expansive as this, but certainly you expect some more downside. So just remember, in terms of setting our bias, we're not actually concerned about price targets or how big the candle is going to be. We're just looking at the direction. So based on these two candles, my expectation is that the next weekly candle would be to the downside as well, so our bias is bearish. So we're now going to use our daily time frame to pick where we think price is going to draw towards. So if we look at the chart here, we have our bearish bias from our weekly analysis, and so we're looking for lower prices. And so if we look to the left, we can see there's 2 points that clearly stand out. We have the low of this candle here, and we could potentially target the low of this candle here as well. But we'll just target this low here, and so this is where we think price is going to draw towards. So if we zoom in again to our hourly time frame, this is where we're going to be looking for where liquidity might be residing and where we think the market is going to attack that liquidity. So remember, we have our bearish bias. We've set our point where we think price is going to draw towards. That's down towards below here. And so if we're going to set where we think liquidity would be residing on our chart, there's obviously 2 points here. So we have pretty much consecutive lows down here, so we just mark that up. and then the high here. So we're expecting liquidity to reside above here and below here. So remember, we would have traders going long from here, setting their sell stops below this low. We'd have traders going short up here, going short the market and having their buy stops sitting here. So that's both sources of liquidity that institutional traders would be potentially attacking and getting set. Now, because we're looking at lower prices, we're expecting an attack higher first on the liquidity up here for those traders to get set for that eventual move to the downside that they would be seeking. So we've just zoomed again to our 15-minute time frame, and this is the time frame that we're going to use to observe price attacking this liquidity in the marketplace. So we'll just play this market forward. So you can see this initial move, we attacked that liquidity that was residing at these levels. And the interesting thing is, if we look to the side, we've got imbalances here, and we can see the market attacking these as well as the liquidity on the 15-minute time frame. Just play it forward a little bit more. So we can see the market pushes higher again. It completely fills in this imbalance to the left here. And you can see the market pushes down, but we're starting to create equal highs here. So we know that when this is happening, this is what retail traders will be interpreting as resistance. So we know that they are getting short here and that they're placing their stops above this level. So we could anticipate that the market is going to at some point attack this level here, seeking that liquidity to get set for that eventual move to the downside that we're anticipating based on our weekly bias and our price target from our daily time frame. So we'll just play that forward a little bit more, and you can see that's exactly what happens. So the market pushes through these two highs into this liquidity zone here where all these stops are residing. And so this is the zone of interest that we have. So this is this liquidity zone that we're interested in here, and this is where our entry will reside. So what we're going to do now is zoom into the 2-minute time frame, and we're going to use that 2-minute chart to define our trade setup and entry, manage the trade, and also exit the trade. So you can see we're sitting on our 2-minute time frame now, and we can see the market has pushed up past these two equal highs into this liquidity zone here. The market's pushed up and now created this higher low. The market's traded back up again, and then this second candle is the one that breaks market structure. So it breaks the low here. This candle breaks that low and creates a new lower low, so this breaks market structure, and this is where our fair value gap resides. So our fair value gap, remember, is a 3-candle setup. So we have this first candle here, the body of the candle, this number 2 is where the gap is going to reside, and the third is which creates our limit for getting into the market, and obviously the top of that fair, or the bottom of that fair value gap. So the fair value gap here, we'll just draw it in, would be from here to here. So the fair value gap will reside between the low of the first candle and the high of the third candle, and should encompass most of the body of that second candle. So you can see that's the zone that's being created just here. And in terms of entering that particular trade, we can do it in 2 ways. We can set a limit order basically at the high of that third candle. So that's where we would set our sell limit, and our stop would reside at the high of the first candle here. And alternatively, if we actually just want to sit and trade at market, we can just have our sell order at market ready to go, and we can just wait for price to trade into that fair value gap and trade at market to get set. And then obviously you'd have to monitor your stop either manually, so you'd have to be ready to close out, or then posthumously put your stop in after you've got your initial entry set. So here we have all of the requirements we have for our fair value gap entry. So we have the push into liquidity, we have this new higher low being formed, our fair value gap gets formed next with this 3-candle formation, and the second candle in that fair value gap formation breaks market structure, it creates a new lower low, and so we have all the requirements that we need to validate the entry of this fair value gap system. If we just play this forward, we can just wait for the market to trade back into that fair value gap where we would get set, and then we'll just figure out where we potentially put our exits, and then also map out the maximum return this particular trade would have been able to return. And if we just pause it there, you can see the market's traded back up into that fair value gap. And so if we had our limit order sitting at the high of that third candle, we'd now be in that trade with our stop at the high of the first candle. Or alternatively, we could have been sitting waiting at market, just ready to jump on the trade as soon as it trade into that fair value gap. So I'll just change the time frame now. We'll just go out to a 4-minute chart just to speed this up, and we'll just watch what happens. So you can see we're almost instantly into profit. Now, if we were in this trade for real, we'd be obviously looking at where our take profit points could be. And there's a few different places that I'd be looking at if I was actually in this trade for real. So the first one that I think would be the most obvious is this initial low down here. So we know that at this point, we know that there'd be liquidity here because we'd have traders having gone long here and they would have their sell stops here. So it's a natural first take profit point that we would look at this low here. Now, if that was the case, just mapping that out quickly, even if we took the whole trade off at that point, you can see that that's a 6R return. So that's a really great trade in on of itself. The next point that we'd look at potentially to take a profit would be down here. So you can see we've got an order block here. So we have this down move before we have this big up move. So there's an order block here. We've also got another low here. So as we would here, we would have liquidity residing here. And we also have fair value gaps sitting in these zones here. So you can see you've got one here. And we've got another one down here. So we know that when price starts to move in our favour, it's going to attack both liquidity and these imbalances on the way down. So a natural place is obviously this one. We have a fair value gap here as well as this particular stop here, this liquidity residing here. So that's a natural first place to take profit. The next one is down here at this low here. We also have that fair value gap here. So again, price would be attracted to this point. We have our next one, which would be potentially down here if we're prepared to hold the trade that long. There's also, again, a fair value gap residing down here. So we know that the market has got a lot of reasons to come down into this zone and start to seek these out. So as the market goes bearish, it seeks out these bullish imbalances and these stops on the way down. And potentially we could trade all the way to the other end of the range. So if we map these out, if we went to this second take profit point here, you can see that's a 9R return. So again, that's a really fantastic return. And if we manage to go all the way down to here, yeah, that's a 14R return. That's obviously a really fantastic return. And if we went all the way to the end of the range, that would be almost a 16R return. So that would be quite exceptional. Now, one of the things ICT talks about is this concept of a discount and premium zone. So if we looked at the market range for the day so far, so we had the open down here and we had the high, which is where we got set. So this is our premium zone here. So we always want to be selling at a premium, buying at a discount. And you can see here that we've sold right at the top of that premium zone. Our first take profit is just inside this discount zone. And then our second and third take profits are much deeper in that discount zone. But what we're going to do is play it all the way through and just see what kind of return this particular setup could have potentially given us if we were able to capture the entirety of the move. So let's just play that forward and see where we end up. So you can see it takes a little bit of time to get going, but once it does, we attack these stops here, this fair value gap, this stops here, this fair value gap here, and it's not until we get right down to this point down here that we see the market takes a little bit of time to consolidate at this zone. But let's just see what happens next. There's a little bit of indecision, and then the market just nukes downwards. Now, if we zoom out a little bit, now what's really interesting is we have our price target down here, which is what we set on the daily time frame. So remember, that was the price target we were looking at price to draw towards over the course of the week. But we've pretty much made it in one session. And this one small fair value gap setup has actually captured nearly all of that move. So if we extend this out down to, the extent of this move down here, you can see that's like a 24-hour return. So that's really, quite exceptional. Obviously, in reality, it's very, very unlikely that we would actually manage to stay in the trade that long, given that the first take profit zones, I think were 6, 9, 14 or whatever they were, they were significant in their own. So it's very unlikely that we would carry it all the way through to, capture the whole of this return. But it's an interesting experiment to see just how much of a move that this potential setup could capture if we were able to hold it all the way through. So there you go, there's the homework from lesson 2 and a bonus Bitcoin example using the whole end-to-end methodology that's been taught in the mentorship program so far. I hope you enjoyed that video. If you did, it'd be great if you could like it and subscribe to my channel if you'd like to see more videos just like this one. Thanks for watching, and I'll see you in the next video.